video, I'll be sharing my analysis on Nvidia stock at $180 per share to see if it's a good buy on the dip or if it's just an overvalued growth stock to avoid. Just like Tesla stock in 2020, Nvidia stock seemed to pop out of nowhere as one of the biggest technology companies in the world within a very short period. From the lows in March 2020, Nvidia stock rebounded over 540% within the span of less than 2 years, having become an $800 billion giant at its peak share price late last year. Now, this actually makes quite a bit of sense when you think about the strong COVID-induced demand for computer GPUs or graphics processing units, which are Nvidia's specialty. However, more recently, Nvidia stock has become one of the worst performers of 2022, where the share price is down about 45% from all-time highs. And a big reason that Nvidia stock has not rebounded from its recent lows nearly as much as other tech giants like Tesla or Apple is because of their disappointing Q2 earnings release on August 8th, which we'll get into here in a minute. So the big question remains, is Nvidia stock finally a buy, being down 45% from its all-time highs? Well, in today's video, I'll be answering exactly that right after you destroy the like button to help support my channel. I would really appreciate that. And by the way, I analyze all types of stocks in the market, so if you do want to see more of this content, make sure to subscribe down below. Alright, now let's get straight into Nvidia's Q2 earnings pre-release from August 8th. Starting with the top line, we can see Nvidia's total revenue only came in at $6.7 billion, while they were guiding for $8.1 billion, and this represents growth of only 3% year over year and negative 19% quarter over quarter. The main culprit for their lackluster growth this past quarter is Nvidia's gaming segment, which fell 33% year over year and fell 44% quarter over quarter, and is currently the second largest revenue segment for the business. To give you a brief explanation, Nvidia's CEO Jensen Huang said, "Our gaming product sell-through projections declined significantly as the quarter progressed. As we expect the macroeconomic conditions affecting sell-through to continue, we took actions with our gaming partners to adjust channel prices and inventory." So clearly, Nvidia is no longer benefiting from the tailwinds of the stimulus-induced pandemic era, where everyone was working from home and needed all kinds of computer GPUs and gaming accessories. And let's be very clear here, guys, this is not just a supply chain issue, this is a demand problem. However, one part of their Q2 report that I really loved was the fact that their data center revenue increased 61% year over year and then 1% quarter over quarter, which is now their largest revenue segment overall. For me, this is the most interesting part about Nvidia's business model because it is highly recurring revenue and very stable margins, just like it would be for Amazon Web Services or AWS, for example. If Nvidia's entire business model were built upon the data center and cloud revenue, I can almost guarantee they would not be seeing these huge fluctuations from the boom and bust cycles within their GPU sector and the gaming sector. Overall, the long-term industry trend is for a migration to the cloud, which will benefit Nvidia's data center division for many years, if not decades to come. But this segment might also be seeing declining growth moving forward, as they only grew revenues 1% quarter over quarter, so we'll have to wait and see how this actually holds up. Finally, Nvidia did also see massive growth in their automotive revenue segment, being up 45% year over year and 59% quarter over quarter, where they focus on providing AI infrastructure for self-driving cars, both in the aspect of hardware and software. And while I do still think Tesla is far in the lead when it comes to their full self-driving technology and their data lead, there will be multiple players within this industry, and I can see Nvidia being one of the leading players beside Tesla. However, it does still only comprise a small portion of their overall revenue, as we can see, so it might not move the needle much in the short term. Moving along, Nvidia's GAAP gross margin collapsed in Q2 to 43.7%, down from 65.1% in the same quarter last year, which is a massive decline of 2,140 basis points year over year. Now, management did try to back up their claims in saying that Nvidia's gross margin profile is still intact, where they say, "We have slowed operating expense growth, balancing investments for long-term growth while managing near-term profitability. We plan to continue stock buybacks as we foresee strong cash generation and future growth." However, the issue is that operating expenses are below the gross profit line in the income statement, so the fact that Nvidia's gross margins have been decreasing significantly means that they have been either increasing their cost of goods sold or they've been reducing their prices significantly. And sure enough, I found out that the company has had to reduce their GPU prices considerably over recent months, and that goes to show that Nvidia really doesn't have that much pricing power at all during these economic times. Now, on the other hand, let's consider Tesla, a company where it's been raising every single EV price that they offer over the past 2 years, yet they still have insanely long wait times. On top of that, Elon Musk literally just just tweeted that they're going to be raising the price of their full self-driving software again, this time from $12,000 to $15,000 US on September 5th, 2022. And the whole reason I'm telling you this is because there can still be very strong demand for certain products in the market, even though we're going through these economic times, and unfortunately, Nvidia does not have that strong of demand, so therefore they have to reduce prices. Alright, but now let's talk about Nvidia stock's valuation, which should give us a much clearer image of if this stock is a buy or not. First of all, I calculated Nvidia's trailing 12 months of both GAAP and non-GAAP earnings per share to be able to calculate their price to earnings ratio. So over the last year, Nvidia has non-GAAP diluted EPS of $4.89 and GAAP diluted EPS of $3.73. But keep in mind, these numbers are pre-Q2 earnings since Nvidia hasn't fully released their earnings report until August 24th, so we will have to wait for that to find out what their actual PE ratio will be. Anyways, for this video, let's assume Nvidia's share price is $180. Thus, their non-GAAP trailing PE ratio is 36.8, and then on a GAAP basis, their trailing PE is 48.3, or almost 50. So because these numbers only include one quarter in 2022 so far, and it mainly reflects how Nvidia was performing back in 2021 when they were the most profitable and had the highest margins, these PE ratios will rise significantly after their earnings report comes out on August 24th. Now, assuming Nvidia's trailing GAAP PE ratio rises from 48.3 to about 60 after Q2 results come out, this seems quite expensive for a company that saw its gross margins collapse by like 2,100 basis points year over year and only managed to grow revenue by 3%. Now, another valuation metric to use for Nvidia stock is the price to earnings growth ratio, or the PEG ratio. We know that analysts are predicting Nvidia's EPS to grow at a compounded annual growth rate of 22.8% over the next 5 years, giving us a PEG of 2.6. And to be honest, this really isn't that cheap when you compare it to many other growth stocks in the market, like Tesla, for example. And this EPS growth rate could go down after Q2 earnings come out, so we'll have to wait and see what analysts project. Alright, so given all of that information we just went over in their Q2 earnings pre-release, is Nvidia stock finally a buy, being down 45% from its all-time highs? Well, the first thing you need to understand is that just because a stock price drops about 50% does not necessarily mean that it's a good deal or on a discount, and that is especially true for Nvidia stock. There's absolutely no question in my mind that Nvidia's fundamentals have deteriorated this year compared to last year, which means the company deserves a lower valuation for lower future expected growth rates in both revenue and EPS. So I'm sure you can understand it's hard for me to say, yes, Nvidia stock is a screaming buy right now, when in reality the stock could be at around fair value, if not overvalued, due to their GPU demand dropping off a cliff this year. Going back to my Tesla stock comparison, we can see the stock price is still down nearly 30% from its all-time highs, but nothing has deteriorated within the business fundamentals. But the difference is, nothing has deteriorated fundamentally within Tesla's business. In Tesla's case, it's only been the macro environment that's brought the stock down to these lower levels, which I believe is presenting a great buying opportunity, but the same is simply not true for Nvidia stock. Now, I could be completely wrong, guys, and I hope I am, but until Nvidia starts seeing more stability and predictability in their revenue and EPS numbers, I'm not going to be buying the stock. With all of that being said, however, Nvidia still is one of the world's leading technology companies, revolutionizing so many different industries using AI, such as social media and creating the Omniverse, autonomous driving hardware and software, supercomputing, allowing them to accurately predict the weather, healthcare and life science research, and so much more. So buying into Nvidia stock might not make sense on a fundamental valuation basis today, but it's more of a call option on the applications of AI, hardware, and software across so many different industries. Not to mention, Nvidia's founder and CEO Jensen Huang is truly a visionary and pioneer in the world of technology and AI. So let me know in the comments below if you plan on buying Nvidia stock on this 45% dip, and tell me why too, because I would love to know if I did miss any important points about the business. With that being said, please remember to like and subscribe if you did enjoy this video. I would really appreciate that, and I will see you guys in the next one.